All right. Well, welcome to the Boring Millionaire. My name is James Lamantia,
I'm Nick Polari.
and we are the Boring Millionaires. So today is Friday, February 21st, and we have 6,019 on the S&P 500. We got 19,568 roughly on the NASDAQ. As you could see from the expression on Morgan, we're having a little bit of a down day today, but like we've mentioned in the past, all it is a shopping opportunity. It reiterates the strength that we have in the market, the fact that we are falling and being bought on these down days. It's not so much of a rally from the bottom that we're experiencing today. However, the trading volume is showing that people are buying on the way down. It's totally normal. It's a totally healthy market. And we hit an all-time high, a fresh all-time high on the 18th, and that was 61.29 on the S&P 500. And then the following day, we saw 61.44 on the S&P 500. So we're inching higher into record territory, and then we experience days like today where we kind of just cool it off and take a breather, and the market just goes, basically 2 steps forward, 1 step back. But as long as the steps forward are more than the steps back, we're in perfect shape.
I feel also too sometimes when we hit those record highs, that's when people want to take some of their money out. It's new territory. We've never gotten here before, so it's like, can it push more? Can it not? So let me just take a little money to be safe. Let me make some money on the investment I already have. When the market goes down, I can re-put the money back into stuff that's fallen, like you said, buying on the way down. When it starts going back up again, I can make money off the money I already made. So
Absolutely, yeah. And we're expecting to see a slow burn kind of market. We've broken into the new all-time highs. We have perfectly good signals, indicating that everything is going to continue pushing forward, but nobody's going to want to rush. To the point you just made, at new all-time highs, people get a little timid. They want to secure the bag, take some profits. So it's almost like a bridge meeting the two ends whenever we see all-time highs. You have the people who want to secure their positions, secure the profits that they made in the uptrend that we've seen in the market. We're also going to have a market of people who are new to investing as well as building positions in these companies. So there's going to be a seller and there's going to be a buyer. So it's really just which measurement outweighs the other. And I think on the days fresh off of a all-time high, we'll see the seller have a little bit stronger of a hand in what goes on, but the buyers will be there to buy it up. That's what everything has been showing us in this market lately.
And also, like you said too, it's always good to be conservative too, because if you're trying to push forward when everybody's pulling back a little bit, I mean, that is how you lose a little bit of money. So it's not bad to just take a step back, take a look at everything that's going on instead of just trying to rush in and you think it's just going to keep going, so you're trying to make your money off it. No, you got to wait for your opportunities.
Yeah, absolutely. It's all about opportunity. And again, we mentioned, I'd say about a month and a half ago, that the market was full of market news. There was a lot going on. There was earnings. We were looking at Fed meetings. However, a lot of that news has been passed. Earnings is essentially over. We have a few that we want to go over. There's a few more hanging on that, we'll still see the results from. But earnings season is essentially over. So all of that news is already behind us. It's out of the market, as well as the Fed put out their minutes on Wednesday afternoon, kind of just a little brainstorm workshop session to give the world an idea of where their head is at. And that workshop session indicated that they're in no rush to cut rates. So we're not going to get a blast from that. That would certainly incentivize people to invest, but they're putting the brakes on it. They're in no rush. So,
like you were saying before, the news slowing down, it turns into a slow burn. When we were covering the earnings last quarter, the same thing happened. There was a lot going on, and also with the inauguration and with Trump getting elected, I think there was a lot of positivity behind that in a lot of people's mind. But as you saw, after the earnings season killed out, after all the hype, after all the news, we went into that slow burn. Nothing really crazy going on. So then we hit the next earning and we're breaking record highs. So it really is a lot of news cycle that I feel affects the market and just moves it, I feel, at a faster pace, either up or down.
Exactly, yeah. When there's a lot of news in the market, that gears the direction that it goes in, the kind of momentum that it gets to that direction in. So with lack of news, there needs to be more traditional stock picking, finding the opportunity, and that's what we're here for. We are giving you the tools to identify these opportunities, and what we should really be looking for at these all-time highs are the stocks that are slow, the stocks that are lagging. They're a little bit just far behind on what the rest of the market is doing. So an important thing to look at is if most of the stocks in the stock market are hitting all-time highs or new 52-week highs, which ones are underperforming? If the market is up 5% for the week, what stocks are up one or two. They're not necessarily doing bad.
Mm-hmm.
They're just underperforming and kind of catching the tail end of the rally.
Like we were just saying 2 seconds ago, if you're in all-time highs, that's shaky territory. If they're just slowly growing, but the market's doing good, it might be better to put your money into these things, or maybe a couple stocks slide, and then there's your opening there. So it is, I always am weary about buying at all-time highs, but then there are strong companies that take a little bit of a dip, or maybe the market hasn't realized, they're not at the point that they need to be at. So then it's a perfect time to get in, and then it's a perfect time to watch it grow. It's the perfect time to look for opportunity.
It really is. And one example of finding a laggard is United Healthcare. So even today, the news came out that there's a probe going into their insurance practices. So it's just bad PR. It really doesn't play a role into how they operate their day-to-day activities within the company. It's just bad PR. So the stock is getting wiped while we're meeting all-time highs. So it's something like that you could find opportunity in. Every stock, just because it's doing bad, doesn't make it a good buy. You need to do your homework on the stock and discover why exactly is this stock underperforming, what kind of news is going around, how is their last earnings report, especially that we just finished earnings. So if you're going and looking for opportunity in the first 2-3 weeks after earnings season, what is their outlook? We've always mentioned how important their outlook and forecast is. I would read into that. But United Healthcare is an example where it's just bad PR. The company isn't failing. They're just facing further challenges brought onto them by the outside world. So I think they'll overcome it, and it's just a buying opportunity.
Every instance I've seen, whenever the government's getting involved with anything, the stock always falls.
Yeah.
I think it's just uncertainty. People don't know what's going to happen, especially with a lot of antitrust stuff, especially with this probe. You don't really know the outcome of it. Most of the time, nothing really happens.
Exactly,
and it's
yeah.
just a lot of fear that, okay, maybe they get hit with a lawsuit, maybe it disrupts their business, maybe they have to change their business model, and now it's new challenges. But overall, I mean, it's not going to go anywhere. Like you said, it's not in bad shape. It's just the government's looking into it, and this could take years for anything to actually come of it. So I think it's just uncertainty.
It really is. It's entirely uncertainty. It's uncertainty in the results that could come from the probe. It's uncertainty in the timeline that it could take to even get to those results. So it's just bad news surrounding the stock. It's nothing as far as their fundamentals or their budget or anything within the company. They are still the leader in health insurance and the insurance market. So I think it's a great opportunity to be getting into it.
Yeah, I agree. And also touching on that topic also too, just like looking into the company with earnings reports too, that I've really noticed, Carvana destroyed earnings. I mean, they beat them. The revenue up for the fourth quarter was up 46%. Their overall sales were up roughly 33% over the year, and they have a strong outlook on 2025, but they nosedove a little bit, but they're still a strong company. I mean, they still have great outlook. So I think that's an open for that. And another earnings report I was looking at was Walmart. I mean, they beat it. Their growth was up, but they expect slower revenue growth in the fiscal year. I don't know. I think people think that's like a negative. Sure, you're not growing at a pace that you were. You might slow down a little bit, but again, like we've said, Walmart's not going anywhere. Everybody goes to Walmart. Everybody buys from Walmart. They've been growing their online customers. So I think they're in a good spot. I think they're just looking at a little bit of a slower year, and it just scares people.
I agree. Yeah. I mean, it's really not a true negative implication on the company itself. It's just a little bit of almost feels like people are finding an excuse to sell these two stocks. They both had killer earnings, like absolutely killer earnings, but the stock had fallen. I do think in the particular instance of Carvana, I think because we rode a wave from $4 to $290, I think there's a lot of high stake investors who are looking at it saying, I need to liquidate. I need my exit strategy. And after 4 consecutive killer earnings reports, those people are saying, time to secure the bag a little bit, liquidate some of my funds. So with the fall in Carvana, it did fall yesterday on the initial fall and went right to its 50-day average. Today, it sunk a little lower to its 6-month average. So again, just a reiteration, like we always like to say, those averages are important key factors when trading and buying stocks. But I think the bad news is out already. I think the panic selling has more than outdone itself, and I think this is where we're going to land. Last week, I was a buyer of Carvana, in theory, because I am exiting my position as well. But if I was somebody who owned 0 shares in Carvana, I would be a buyer at this level right now.
No, I would also. And like you were saying, people taking profit. We've been saying about taking profit. I mean, you even said you're trimming your position. I mean, there's probably people that have huge positions in this, and it's like, it's at $280. Like, let me take a little bit. And I think once it starts tumbling a little bit, other people who have big positions are like, oh, well, let me get out a little bit. So I think it just needs to find its bottom. I think it just needs to find the strength. And then I do believe it's going to grow again. Perfect earnings. I mean, it outperformed. It has strong growth for next year that it expects. So why would it fall, And
Exactly.
I do think it is just a little bit of a sell-off to get some of your money back.
I agree. Yeah, I really just think it's people getting out of the position that they've had, because even if you only got into Carvana halfway through the recovery story, if you bought it at 120, even down now at 240, you're still up double. So, I mean, it's rational for people to exit that position, and I think that is where a lot of the selling is coming from. So no worries. Like we've said, they have great forecast. Everything is looking good. Yeah, there's no reason really to dump the stock.
And also, too, I've mentioned this before, I'm a big believer in a buy and hold strategy for one of my accounts, and I feel a lot of people in Wall Street don't really look at it like that because, one, this is how they're making their living. This is, what's paying for pretty much their lifestyle. So I feel like when they can make money like that, they're going to get in, get out. But also, if you have such a high profit, they could see other opportunity, especially a lot of the red coming in, and they're like, okay, I could sell off 1,000 shares of Carvana and put it into United Health or put it into just another company that's falling. So it's just more opportunity to grow the money that they already have. And it's like it's at 280. So let me take some money off that. And then if I put it into something else that grows, I can expand on what I already have.
Absolutely. Yeah, you raised a great point. It's key to recycle the money that you make in the market if you're looking to continue building and restructuring your portfolio. If you have excess profit in one position, you just use it to raise the balance of everything else. You make it an even tide basically across the whole board, which is how I like to manage my portfolio. I have core stocks that outweigh the rest. I have a little bit of a B tier that outweighs the rest, but generally they're all at the same pace. I just want that much of an investment in that company. I love to consider the idea of how people will just recycle their money and reposition it. We're talking a lot about buying the stocks. We're buying them on discounts. However, it's just important to remind ourselves why we would be buying stocks and making these investments. I mean, the general 1-2 way is to just build a nest egg. So it's simply said enough like that. But what does that nest egg do? It could pay for college. It could just build fortification for your life, for your family. It could pay a house off several years early. So we're not trying to get you rich overnight. We're trying to just build you wealth in a boring, long-term manner. And there's no negative repercussion to having a nest egg built. Why would you not want that fortification of money built around you?
And I've said before, I mean, you can also look at it as a second income. Instead of just working, your 9 to 5, your 40-hour a week, that's all the money you have. No, if you start taking some of that money, you can use that money to make more money. So it is just another revenue stream. And that is really the key to financial freedom, is just having more money and just using your money to make more money. I mean, it's just a tool. We've said it before. Money is a tool, and how you use that tool really, I feel, determines the kind of lifestyle that you will have, and investing is just a great way for comfortability.
It really is. And we always preach about the dividends that companies pay. So every quarter throughout the year, they pay you just for owning the stocks. That's income coming right into your bank account, just in the background. You don't have to really labor for it. It's just investment and discipline as holding those investments. So beautiful avenue to explore as far as building income. It certainly generates more of a lifestyle that people could take advantage of. I think it's important to just reiterate how to actually get into the stock market. We're always giving you the picks, but the important part to remember is that it's as simple as downloading an app. We use Charles Schwab. However, you could use Robinhood. Webull is not a bad one either, as well as Acorns is the one that CNBC uses. Yeah, you just download the app, you sync your bank account to it, you could deposit a picture of a check, and then within the same day, you'll be able to trade real deal stocks such as Apple's, Amazon's, Microsoft's of the world. So it's as simple as downloading an app just like any other that we use on a day-to-day basis.
Yeah, so let's just say you're a new into investing. You just download the app. You have $50. You have $25 even you could invest in. What would be your picks for that?
So what I would do, I would go right in and I would take, whether it's $50 or $25, I'd break it up into 5 different pieces. We'll just use 50 as an example. And we'll take that 50, break it into 5 $10 increments. And the first increment I'm going to use is XYZ. XYZ is the ticker, but it is block, which is actually Square. So Square is one of the leaders in person-to-person payment methods. They are adapting into the crypto space. Jack Dorsey, the CEO and founder, is absolutely in love with crypto, and I think he is one of the key players that's going to create the breakthrough from making crypto some sort of background, digital market currency to something that we would use at a Salad Works. So I think Square Block technically is the name of the company now, ticker XYZ. I think they're the leader in that. They did awful on earnings. They fell quite a bit today, and they fell just under their 1-year average. So like we were saying at the top of the episode, we're slowly grinding into all-time highs in the general market. Here's a discount. They missed earnings. Not ideal, but it's a proprietary piece of the way that we live in the world. So I want to be involved in that. 2 weeks ago, I was talking about Disney. So today I'm pulling the trigger and putting $10 of my 50 list into that. The averages are just lining up very nicely. It's sitting right at its 50-day average. Could sink a little lower to the 100-day average, but I think it's perfectly in a position to start buying. And with the portfolio that they have, it's almost a no-brainer. I want to be involved in everything that they do. Another one I'm looking at this week is FedEx. So FedEx, one of the leader in logistics, they are presenting a macro double bottom. So what that actually means is over the past year, it fell to these levels twice. So the fact that it hit this level a second time is telling me that it's ready to be bought. And I think, along with its 2% dividend, it's an easy decision to make. Let's buy this company, let's stock up, get that income generating in the background. My next one is Ferrari, because it has remained stagnant for the past year, but after its earnings report, it just broke out. So I think that it's beginning a breakout rally, and I just want to get in earlier on that. So no real trading analytics. I just think it's going to be ready to move now that it's breaking out of that range. And my fifth one is Nike. So Nike has basically been just going down for the past 3 years. Not really on major specific news. They're just not really finding their feet on the ground. They're just not getting it together. So I do think that it's time to buy. The charts are starting to tell me it's a good time to start getting your money in. I will advise, I don't think it's the lowest penny value that it's going to be at. We might have a little bit of turbulence after this purchase. However, I think on a grand 5-year scale, it's hitting this bottom twice, like I just mentioned with FedEx, and it's going to rebound after that, along, again, with a 2% dividend being made in the background. So that's where my 50's going. Where are you going to put yours?
Yeah. Funny enough, a lot of what I'm doing, I'm building on my positions because I'm buying on down, because buying on the way down is never a bad strategy, as long as there's reason. Because again, if stocks are just tanking and, poor management or poor productivity, or the company's just in a real hole, maybe not buy on the way down. But these are strong companies that I would like to lower the cost of my entry into them. So the first one would be Chipotle. They didn't have bad earnings. They met exactly what Wall Street thought. That one's just getting beat up a little bit today. The next one is Amazon. I mean, I know that their outlook for the first quarter of next year wasn't the greatest, so I think they're getting beat up a little bit. Perfect time to get in, lower my cost. I got in at 230. It's at 215 now, so let's bring it a little in the middle. So I spent less. I can make more when it goes over that. United Healthcare, funny enough, we were talking about that. I love bad PR. There's a lot of moves I've made on bad PR, and they were strong companies that always dug their way out. So I think lowering, my cost, because I got in a little higher than where it's at 468, so I think that's a good time to get in. Another one, your golden child, Carvana. I think it's time for me to get in on that on my $50 list, because I have it in my other account, but it's fallen to a great spot. I mean, it beat earnings. It's killing it. It has positive outlook. So I definitely want to get involved in Carvana. And then my last one, which kind of rolls into another point after this, is Coinbase. Coinbase is taking a little bit of a hit. I think I'll explain what this is in a minute, but I think we're starting to hit a crypto winter. So
definitely,
that's going to hurt Coinbase a little bit because people aren't going to be using it as much and the transactions aren't going to be there as much. But I'm going to buy Coinbase on the way down, because if you look at charts, it gets beat up. We've had multiple crypto winners. When it starts to come back, the stock just takes off. So I think buying on the way down would be safe.
I absolutely agree with you. And to expand on a point you just mentioned was the crypto winner. So what a crypto winner actually means is crypto typically trades in 4-year cycles. Every 4 years, you'll see a major increase in price and then the slow deterioration of that price. We've seemed to have passed the influx of the hype trade when Bitcoin was at 109 and the silly meme coins were just flying through the roof. that is an indication that we are at the height of the crypto market. And now I would anticipate for the next 2 years, we're going to just see a constant decrease in price. But that opens up the opportunity for everything that we're talking about, because crypto is going to be an innovator in the way that we live in the world. It's technology, it's not coins. So as that continues to move forward in the world that we live in, and the adaptability continues to be seen all through the world, there's going to be a stronger reason that we need to be invested in crypto. And I think this crypto winter is going to create the opportunity to build on that position.
No, I agree with that. I've actually been looking into a lot more. Again, the utility coins, not the meme coins, because as we were talking before, there have been a lot of pump and dumps. So that's pretty much introduce the coin. A bunch of people, will start flooding money. And then when it hits a certain point, people that are large holders of these coins will dump everything they have, completely killing the price. And in those, you can lose a lot of money. I mean, there were examples. I know.
Haktua.
Yeah, the Haktua, that was a pump and dump scheme.
Dave Portnoy.
He did Barstools. It, yeah, and he was like, am I supposed to get in trouble for this? But there's not a lot of SEC regulation around it, so it's not really a criminal charge. So people are taking advantage of that.
And I want to interject in that point. It is almost an atmosphere for criminal activity to prey on people, because, to your point, there is not a lot of SEC, which is the Securities Exchange Commission. They are the authority over the stock market and things of that nature. So they have no judgments and rulings on a lot of this crypto stuff. So Dave Portnoy seems like an all right enough guy. Maybe he was just joking around, but I'm sure there are individuals who are saying, I can do this and get away with it, and they have no repercussion to getting their money back. So we are advising to stay away from silliness.
Yeah, you can get burnt really hard. These are pretty much legal scams
to a degree, yeah.
So just be careful about that. The utility cryptos have always just been more of a safe bet. That's what I know I'm putting my money in. I know we've said it before. I mean, you can buy pieces of Bitcoin, so it's like fractional shares of Bitcoin.
Exactly.
Yeah, so you could do that. Cardano is a good one. Ethereum. They're just the safer coins, the coins that I think will have more use in the near future.
They absolutely will. Matic and Mana are two more I would like to include. XRP is pretty decent. It's really not that bad. But I mean, outside of that, it kind of strays from having a core utility value to the technology of the crypto market. And I mean, it's almost a silly comment, but I would like to say, if you're introduced to a coin based on its name, its image, or a celebrity associated with it, I would not buy that. The crypto market is going to open up in this crypto winter, and I don't think there's a need to put all of your funding and capital into it this week, but I think the opportunities are going to present themselves. So as the stock market breaks into all-time highs, if it becomes maybe a little difficult to find opportunities, some of the opportunities would be more so presented in the crypto market. It's balanced, disciplined investing, and that's what we're all about. We're not in the Wild West trying to gamble on the stock market. We're here to give you the valuable picks and the tools and resources to identify when they're a good buy. So with all that said, follow us on Facebook, follow us on Instagram, and just continue to tune in and understand how the market works and how to make money in the stock market. And if you're ever a little bit unsure, shoot us a message. We will always answer you.
Yeah. So thank you for watching. Until next time.
Thank you.